Is it okay if I take a couple of minutes to just give you a little bit about my background?
Mm-hmm.
Awesome, thank you. So I actually started working in accounting at Deloitte, which is the world's largest accounting firm. And I did that many years ago now. And when I was there, I realized big business is not for me. So very quickly, I got my designation. At the time, it was a CA designation, and now they merged to become a CPA designation. And once I had that, I basically left, went to a small firm to get a bit of experience. But me, I've been an entrepreneur at heart. I've been a business owner since I was in my teens, ran many different things, done lots of different projects. And so I left them and went out and started my own firm. At the time we had another partner. We grew it for a few years, and in 2017 he actually left, went to focus on some other businesses that he had, and I continued to expand our firm. And so today we've got RMI, we're small business accountants. We specialize in everything from bookkeeping to all the way up to audit work, and I'll talk about some of that stuff after. But basically, we're a team of now about 45 people, and so we got a really good office, good team environment, and one of the biggest things is we always try to actually provide service. Accountants tend to get too busy, and they don't answer, they don't call back, they don't answer questions, and so we like to at least change that perception. So today, I wanted to touch on a few things. So the first one, I'm going to go through kind of the financial reporting requirements. Many people might have experience with this, mostly around the affordability grant. And I'm going to touch into a few things that people might not be familiar with some of the terminology. So I know on the grant reporting, you're getting requests for financials with attestation or a review or an audit. So I want to just talk about what this actually means and give a little bit of background on that. And then I'm going to talk about the different types of work that we can do in order to keep you compliant with the government in terms of the funding that you're receiving on the affordability grant side. And then lastly, really important, some common issues that we've already run into with some of the centers. If we can fix these problems in advance, it makes everyone's life easier, and obviously will save you money in the long run. So touching on this, so of course the affordability grant, and so many people are familiar in this room with it already, but essentially it's the funding that's coming from the government now. The new program changes that have recently occurred do not really change anything on the reporting requirements, so that's going to be fairly consistent and the same going forward. So of course it's really important, it's for the childcare programs. I don't want to dig too much into this because I know everyone's pretty familiar with it. But when it comes to the financial reporting requirements, so there's two different options that the government's actually given. We can go based on their fiscal year, or we can go on your own fiscal year, which is nice to actually do because it allows you a bit more flexibility. And so option one is if we want to go on their fiscal year, the government runs on an April to March year end. And so you can do your affordability grant reporting based on that time period. It doesn't matter if your company year end is December or July, we can report just on that time period and they would accept that. And what's interesting is they have given optional terms, and this is handy when you're a new center, for example. Because in year one, you might say, I'm going to just report on my 9 months because it might lower down the work that you require. So for example, you might get enough funding that you require an audit, but if we can get away with a 9-month period, we can maybe get away with a review for that period versus spending the extra money to do the full work. So as this program's been around now a couple of years, we've done this for a few different clients where we've changed the reporting period a little bit in order to just help save costs throughout. So it's really important to know that you have that flexibility and those options available. Okay. The second option, fairly straightforward. It's based on your own fiscal year. And this is really nice as well, because if you're doing the work at the same time as your own fiscal year for your own tax filings and things like that, you can tie in the extra work that's required with it, and that helps save some costs as well. Last line is really important, due date. So it's 90 days from the time period we're picking. So if we're going back and picking the fiscal year of the government, then your filings would be due by June to them. And if you're going based on your own calendar year end, or if you're going on your own fiscal year end for your company, it's going to be 90 days from the day of your year end. Okay. So what is actually being reported on? And this is really important because I know many people have gone to firms, accounting firms, and they've said, hey, I've been told I need an audit. So they come back and say, okay, we're going to do a full audit on you, and it's going to cost you $40,000. Well, it's not necessarily true, because what the government's actually looking for is specifically on the affordability grant and the revenue tied to that. And so the reporting can be done in a few different ways, which I'll touch on in a minute here. And in addition to the income, they want to make sure that the money being received for the grants is being used for what it's allowed for, right? And so those are common expenditures, things that are eligible, of course, the salaries, the rents, insurance, utilities, basically your operational costs. But what you cannot use the grant for is really important. So the affordability grant specifically, you cannot use it to build out additional space in your facility. You cannot use it to pay out dividends or profits, right? And you cannot do it where you're charging a supplementary cost. So some people will charge extra costs for meals, for example. You cannot use the affordability grant to cover the costs for those meals, okay? So types of financial reporting, okay? So there's 3 different levels that the government's asked for. The first one is called attestation. Now, attestation, very simple, is basically they're asking the business owner or a third-party individual like an accountant to just say, yeah, these numbers have been looked at. So this is basically for anything under $250,000, not of company revenue, but of actual grant received, right? And that's very important to know as well. So if your grant money that you've received is under $250,000, very simple, an attestation report can be done, which is essentially even can be done by the business owner themselves, saying that you're verifying the numbers, okay? The next level up is what we call a review engagement report. So a review engagement report basically is for any business that's received $250,000 up to $500,000 of affordability grant funding. Okay, now in here I'm going to dig a little bit deeper in a minute into what this actually entails in terms of what we're going to be doing in terms of work. But what's really important is review engagement reports and auditor reports can only be done by CPAs, and some of them very specifically, many CPAs aren't even able to do these reports. So you got to look around and find the right partner that can actually work with you on this. And the last one, if you get more than $500,000 in your center for affordability grant funding, they require audited statements. So audited statements is kind of the highest level of assurance that you'll receive from an accountant. If you're a public company, for example, they all get audited. And so the level of work on our end is obviously much more detailed, which means more costs associated with it. Okay. Really important. Unused funding must be returned to the government. So it's really important to make sure these reports are done correctly and very smart too, because the thing is, if you're not reporting your expenses to be equal to the affordability grant funding you're receiving, you're actually going to lose out on a lot of that funding. So it's really important to really understand how the funding requirements work and be able to showcase the financials accordingly. And it's not only important for you to understand them, but really important for whoever's working with you on that side, the accountant that you're working with. And then the last piece on that page, on that slide, so programs that do not complete the funding in their timeline will have a hard time getting future funding. Now, what's nice is because the program's so new and with these recent changes, I'm pretty confident the government's actually been very good to work with in terms of exceptions that are required. Okay, so for example, if you're a new center, not familiar with the reporting requirements, you're already late, give them a call. They'll allow for extensions. They will do this for, I believe, for another couple of years before they're going to start to really crack down on it. But the most important piece is, of course, get in touch and make sure that those discussions are being had. What's really interesting, actually on the government end, is they're still learning the programs themselves. And so
they don't even know.
They don't even know. And so they're basically defaulting, saying, yeah, we'll work with you, because a lot of times if you go in and we run into issues with audits, for example, where we don't have all the information, we go to the government and say, okay, are you willing to accept a different period or things like that? They're like, yeah, but then they come back and request the same information. So right now they're still trying to learn what this all means as well, but this is something that's coming into place. It's been a couple of years, it's going to be there for a while, so it's better to get everything done properly now, because it's going to become more and more important in the future. Now I wanted to just take a quick minute. I know this is a bit small to see, but just to show you the difference between the type of work. So I talked about a special audit or a review, and I talked about a regular audit and a review, okay? A regular audit is essentially the level of work that a public company gets looked at. Okay, and I'll go into more details here. But if you look on here, we're reporting, when we do a full audit, we would be auditing your entire company. So that doesn't only mean the affordability grant revenue. It means the parent revenue that's coming in. It's including if you're charging any supplemental fees. It's not talking about only the affordability grant expenses. It's talking about your entire company expenses. And so it's really important to understand the difference, because this is where the cost perspective is going to change. When you go to a firm that's not familiar with this, they're going to come back and be like, yeah, I can do an audit on you. And again, it's going to be a really big bill, right? So if you look at a special audit, you can just see, I know it's small, but you can see the amount that's being reported on. Here you basically have everything your business does, versus here you're very much focused on only the items that are applicable to the affordability grant in itself. Okay? Now, what does a special audit actually mean? So when we're doing an audit, what we're doing is we're actually doing journal entry tracing and testing. And so what we're doing is we're taking your affordability grant submissions and we're actually verifying them to make sure they're accurate. So essentially you're gonna have your attendance sheet and you're gonna have your submission that you're submitting to the government saying that this many kids attended. We're gonna be taking a sample of those and reviewing to make sure the information is actually correct. And so that's where some of the challenges, which I'm coming up to in a little bit, is bad data will lead to bad outcomes. And so it's really important that you're organized on the front half, okay? In here as well, if you have internal controls, some companies will be having some pieces that are automated or things like that. So we'll do internal control testing to make sure that what your software is supposed to be doing is actually doing that. And that's how you can end up saving costs in the long run on some of that kind of stuff as well, okay? When we're doing a review reporting, and again, you can have this two ways. You can do a review engagement on the entire firm or just the affordability grant portion. Now, some people are getting bank financing and their bank might say, hey, you have a couple centers, we're giving you $1 million of financing, you have to get a review engagement done. Well, that review engagement can be encompassed into the affordability grant component as well. And that would just be a full review in terms of your own entire firm, okay? And so the type of work we do in a review engagement is a little bit different, because in an audit, we're going to the details and we're actually doing we're doing sample testing. So we'll look at the attendance sheets, we'll look at your submissions, we have to document all of that. In a review engagement, it changes because we're doing more analysis and more inquiry. So what we'd be doing is saying, okay, your average number of students is this many students, this is the amount of funding, does it actually make sense? And so the amount of work we do, it's more analysis, it's less detailed, it's less time consuming, which of course the good thing means less cost, right? So common issues, I touched on some of these already, but some of the big ones, disorganized bookkeeping. This is the biggest problem that we see. If your bookkeeping is unorganized, it's going to be very difficult to audit, or it's going to cost you a lot more because we're going to have to look at every item. If you've got organized bookkeeping, it's going to make life a lot easier for us, which means it's going to save you a ton of money on that end. So that's the number one issue we've seen. And I find in the childcare center, people are pretty good at this because they understand they need to send stuff to the government. But when I say pretty good, it's the details behind it, right? And so, yeah, you might say, I got a good bookkeeper, they're keeping everything up to date. But are they tracking your revenues differently? Are you tracking your parent revenue versus your affordability grant revenue? Are they actually tracking that all separately? Are they tracking your expenses properly? And are you doing your submissions correctly? Is the attendance sheets done on a regular basis? Are they done accurately? When kids leave is the biggest problem we've run into. We finished an audit on a center and they had a couple kids transfer and it was around their year end, and they ended up having to pay back a bunch of the funding because they ended up overclaiming kids. They had claimed 4 extra kids, I believe it was, for a few months. And so of course you don't want to run into those situations where that can happen, because it ends up becoming a big amount of money that you now owe back. And the government, the way they've treated it is they just stop your funding till they'll take it out from you. So it can have a huge impact on operations. So the better the data going in, the much better chances of success with a good outcome. Accrual accounting versus cash accounting. So many small businesses use cash accounting. And so what does that mean? Well, basically, when we're talking cash accounting, we're talking money in your bank versus out of your bank, and that's what we record. Now, why this becomes really important is businesses should be using accrual accounting. The number one place that we see this in childcare centers is actually in regards to the submissions. So if your year end, for example, is March 31st, and you're gonna do a submission for the month of March to get money in April, that is actually income in that year for you. So it's in the previous year. So even though you haven't received the money, we still have to report that as income. The government is actually looking for that to be reported as income, because when they're on their end, they're verifying the numbers that we're reporting and saying, yes, this matches with what the funding we've given. So you have to make sure you're going more along the time period versus the actual time of the transaction, okay? So really important to make note of that. And then the other big one is misclassification of expenses. So a lot of times if you've got inexperienced bookkeepers or things like that that are working with you, they might record things in the wrong category. Why is that really important? Really important for childcare centers because of the funding again. Okay? If I'm a regular business and I call something supplies versus travel, it's still an expense at the end of the day. Maybe it's not in the right category, but for tax purposes, it still lines up. You're generally okay. But when it comes to the funding requirements here, if all of a sudden a bunch of your expenses are being put into the wrong category, that can come back and impact you on the funding side, because it might mean you're not going to get as much funding, or you might have to return some of the funding. Okay, so really important that what I recommend to a lot of our clients is, if you have a bookkeeper, make sure you're getting reports on a monthly basis. If you're doing it yourself or internally, review those reports on a monthly basis. Don't just give it to the accountant and ignore it. It's really important you have an understanding of your financial statements on a regular basis, okay? And a lot of this comes from staffing and resource constraints. That's, I think, across the board. It's every industry is facing that, but financials, historically businesses say, I gotta go get money, I gotta go run the business, I gotta do this. Accounting is the last thing to look at. I'm trying to say, bring that to the forefront. If you can do your accounting first, it'll make your decision making a lot easier in the long run. Okay. Some other things I touched on a little bit earlier: inaccurate number of children enrolled, inaccurate attendance records. A lot of the reason why the government's pushing for the external reporting is because of these tests that they want. If without this external reporting, there's nobody really holding people accountable to say, hey, you actually have 100 students in this location versus 50, and 50 of them are made up. And so the government really is looking for this external validation and external reporting. So it's really important you're paying attention to that. Deadlines is another really big one. There is some flexibility right now, so I think for the next year or two, as everyone kind of settles into this new world with the affordability grant, we'll have a bit of flexibility, but it's really important you start paying attention to this, because there will come a time when all of a sudden your 90 days hits, you haven't submitted your report, they'll just cut your funding until you actually do submit it. So, okay. And missing documents is another really big one. So it's really important, again, when you're setting up your centers, have a good system to have all of this organized up front, because it's all information that we're gonna need in order to be able to get the reporting to the government to get you the funding. Okay. And like we mentioned, if you don't comply, you're gonna, the risk is you're not gonna get the funding or be withheld from it. I get this a lot with childcare centers, okay? So a lot of people are used to saying, okay, here's my financial statements, I need to get my tax return done. So a lot of that, we call that a compilation or an NTR. Prices, you can kind of see where those sit. But when we're talking about review and audit work, as I kind of alluded to, it's a lot more work. And so I wanted to touch on this because you can see full company review engagement. So this is if you have bank financing, they might ask for review engagement. And of course, these are very general in nature. Some will be more. We do review engagements that are 25,000 plus, but it depends on the company size. Kind of kept this for this audience if we're looking at one center. So cost of about 10 to 15,000. A special review engagement report, you can see, is like half that cost. And so I really wanted to put this up here to give you guys an indication, because a lot of people will say, oh, I need a review engagement report, but you're not clarifying with your accountants what you really need, and you can see the cost differential that it can actually have as an impact, right? Now, if you need an audit, you can see the big difference here. So a special audit, you're probably 10 to 20,000. If you go to somebody and say, I need a full audit done, it'll be 25,000 plus, right? And I've heard stories of people paying 40,000 for an audit, when really they could have got away with a special audit and paid maybe 10, right? And so I just wanted to put this up there to really emphasize the discrepancy between the different types of work that we can do for you on that end there, okay? Just a little bit about our firm. We're a full service firm, like I had mentioned. We're about 45 staff in the office. One location just off of Deerfoot and 32nd Avenue in the Northeast. And we do everything. So we do a lot of audit work on the special audits. We don't work on public companies, only small businesses. Do audit review, bookkeeping, of course corporate taxation, a lot of restructuring work as well. And with that, any questions?